Frank earned his undergraduate degree from Iona University in mathematics, and he also holds a master's degree from Johns Hopkins University. Frank, as many of you know, has been, and maybe again will be, but up to now, he's been two-time president of NAEA, and he has been three-time president of NYSSEA. Frank has won many, many awards from both NAEA and NYSSEA. The two that stand out to me are the award for excellence in public awareness and excellence in education. And I think excellence is the word that describes Frank. I will point out to you that today's webinar does not replace Frank's tax update that we host every year in January. I hope you will join us. It will be January 7th, 2026 at 6:30 p.m. So please mark that date on your calendar. And speaking of marking dates, it's hard to believe, but we're already working on the 2026 NYSSEA conference. We again will be hosting Frank Degen as our anchor instructor. We are already circling up other instructors. We hope you'll join us in Saratoga Springs next October 2026. And it's with great pleasure that I introduce Frank Degen.
Thank you, Jim. Hello, everybody. Good afternoon. We're about to begin our little discussion of OBBBA. You know, normally I wouldn't comment on the cover page, but I did want to mention that we often refer to it as OBBBA, One Big Beautiful Act, whatever it was. That's not the name of it. It was a reconciliation bill. So you'll see me on the cover page refer to it as an Act HR 1. That's the exact name. Obviously, in common parlance, we're going to call it OBBA, but I just wanted to explain why I have that on the cover. I believe that everything we're going to say today is accurate. Obviously, when something is new, there's always the danger of making a mistake. But I do want to caution you, though, that if you may have read other articles or listened to other things early on, there were a number of mistakes in early articles. You know, the bill was passed on July 4th, and people were putting things out on July 8th. And occasionally some mistakes were made. As I said, I think everything is in mine is correct after proofreading it. But you know what they always say, consult with a competent tax advisor before you do anything. But if you think something is incorrect, please you know, ask a question about it. Speaking of questions, I will stop periodically and see whatever questions. Jim and Emily and a couple other folks will be doing some wrangling. So hopefully we'll get a lot out of this. All right, if you, I'm going to refer to the handout. I know Jeff put it out a number of times, so please follow along. I'll talk about a few items that we have there. So on page 2, the first comment I want to mention to you is that a lot of what you read in the press says that OBBBA made things permanent. Remember, this is Washington, D.C. There is no such thing as permanent. All right, Congress can change the law at will. What they refer to as permanent was that TCJA, when it was enacted in 2017, put a period of 2018 to 2025 where the provisions were going to be in effect. And that's why at the end of 2025, if there would have been no legislation, all right, then you would have had a situation where we go back to the pre-2017 bill, but that didn't happen. So when they use the word permanent, that's what they're referring to. There'll be no more 2018 to 2025. Okay, so understand when I say use the word permanent, it's always with a grain of salt. All righty, so if we first thing I just want to mention, the first couple of things are not you know, necessarily something that you have to sort of quote unquote remember, but I just pass it along to you so that you have some understanding. And those are the tax rates. The 7 tax rates that TCJA created were made permanent, meaning that there is no time limit on them right now, though obviously, as I just mentioned, it's subject to change by the Congress. You may read that a couple of the lower rates were given a special bump. You don't have to worry about that. What happened is they measured inflation from 2017 when the bill was TCJA was created. On a couple of the lower thresholds, they started the inflation of 2016. The attempt was to widen the bracket. You don't need to concern yourself about it. Just understand those 7 rates are now in the code. The standard deduction was given a special boost. If you look at your handout, for example, with married filing joint, the 2025 standard deduction under TCJA and inflation was supposed to be $30,000. All right, but in the Dickering, and by the way, when I say in the Dickering, there were 3 versions, if you will, of this bill before it was signed into law. It was the House version. The House initially passed the legislation and put provisions. Then it went to the Senate Finance Committee, and the Senate's Finance Committee had their stab at it, and they made further provisions and some modifications. The final bill was the 3rd iteration. It came in the language that the Senate finally adopted. The Senate Finance Committee was not the final word. It was another creation. Normally, after the Senate does their thing, it goes back to the House. But with the political pressure to get it done by July 4th, the House just voted on the Senate version and accepted. So that when I say it was given a boost, you may see some different numbers. Like from the House, when we get to the senior citizen thing, it was $4,000. The Senate made it 6. Normally that would have been discussed, but politically, it just wasn't feasible at the time. So in any case, instead of the $30,000, what the Congress did is they set new permanent um, standard deductions. And if you look at your handout, you can see that for 2025, the married filing joint is 31,500. That's the baseline. All inflation will be now measured from that number, which is in the code. And likewise, head of household, the threshold is $23,625, and single and married filing separately, $15,750. So those are the standard deductions for 2025 that were given a boost above and beyond what TCJA was. So the reason I mention this to you, you're going to read articles that still refer back to the $30,000. Most of the time, the articles were written pre-July 4th, okay? Um, and then these items, as I said, will be increased for inflation going forward starting in 2026. The next item is the child tax credit. As some of you are aware, was going to go back to $1,000 if TCJA hadn't been followed. It's now $2,200. That's the permanent base amount. In the Internal Revenue Code, everything will be measured from the $2,200 in terms of inflation. I do mention to you that the refundable portion in the Internal Revenue Code is $1,400, but that has been adjusted for inflation going back to 2016 or 17. I don't remember which number they used. So for 2025, the refundable portion is 1,700. So it may confuse someone when they read somewhere in the press that the refundable portion is $1,400. That's what it says in the code. But the inflation has brought it to $1,700 for 2025. As you know, you've been doing tax returns the past few years. There's a threshold at which the child tax credit starts to phase out. It's 400,000 for married filing joint and $200,000 for everybody else. That number, those numbers are not adjusted for inflation. They're going to be quote unquote permanent unless Congress decides to do something about that down the road. The earned income threshold needed for the additional child tax credit is remaining at $2,500. The one thing that you need to understand is the Social Security requirement. If the taxpayer and both the taxpayer and the qualifying child must have a Social Security number. If they are married, at least if they do joint return, at least one of them must have a Social Security number. All right, taxpayer and the dependent child, the qualifying child, in order to get it. And the $500 ODC, which is the credit for anyone who's not a qualifying child, that is a dependent, was made permanent at $500. Okay? Um, and the next one is the QBI, the Section 199A deduction. There was some, if you look at the House had a higher percentage than the agreed upon 20%. The 20% is what's in existence now, and it's just going to be continued as a permanent at a permanent percentage for the deduction. The one thing that they did do is though they raised the phase out thresholds. Previously they were 50,000 and 100,000 for joint return. Now they are 75,000 and 150,000 for a joint return. So the phase out goes for a longer period of time that people can take advantage of this. There is a new minimum $400 QBI deduction for any business that has a net income of $1,000 taxable income. Understand though, inherent in that $400 is that there is a requirement that the taxpayer materially participates in this business. This was not designed to be a giveaway. Someone says, well, maybe it's a hobby, but I have a business and now I want my $400 deduction. There has to be material participation, all right? And you notice they call it an active business. That's the phrase they use, but it's basically material participation. And starting in 2027, that number, the $400 and the 1,000 will be adjusted for inflation. And notice in the handout, it's going to be done in multiples of $5. Many inflation adjustments are done in multiples of $100 or $1,000 or $50. This is going to be done in $5. So you'll see maybe it won't be 2026. Maybe it want to start in 27. Duh. All right. So maybe in 27 it'll be $405. But it won't be 404. All right. It has to be in a multiple of 5. And this $400 provision is only starting in 2026. It is after this year, okay? And then on the next page, the SALT limitation, the SMALT cap. I don't know about you, but many of my clients, I live on Long Island, and typically most of my clients pay, if I had to take an average, around $20,000 in property tax credits. So when the politicians talk about SALT, it sounds good. You know, oh, I'm going from 10,000 to 20,000. And of course, we have a state tax in New York, and as do other places. But unless you have a substantial mortgage, I don't think SALT is going to be as big an impact as we might be led to believe by our political leaders. The high standard deduction is going to be a boon, but it also takes away from the effect of SALT. But in any case, TCJA made the SALT limitation $10,000. that is now permanent in the Internal Revenue Code. But for the next 5 years, that $10,000 is going to be ignored, if you will. So starting in 2025, on 2025 returns, the amount of state and local taxes that you can take is capped at $40,000 and not $10,000. By the way, everything that's on here, married filing separately, is everything's cut in half. All other filing statuses, the numbers are the same. So $40,000 is the cap, except for a married filing separate person where it is $20,000. This $40,000 is going to be adjusted for inflation over this next 5-year period. It is going to be adjusted by 1% each year. So in 2026, it's going to be add 40,000 is going to 1% is $400. It's going to be $40,400. Being a math major, I better get the next one right. The next year it's going to be another 1%. So from $40,400, we're now going to get $40,840. And you don't need to remember the numbers, just remember they're going to be adjusted for inflation. There is a threshold. If you go with $500,000, this is going to start to be phased out. The phase out is 30% of the amount over the threshold, which is 500,000, except for married filing separately. Okay, that would be cut in half. So if a taxpayer, for example, has an, by the way, uh, a lot of these provisions we're going to talk about, I'm going to just say this now, are based on modified adjusted gross income, the so-called MAGI. And MAGI is basically AGI plus the foreign income exclusion. We don't have too many people like that. So if you hear me say AGI, I'm really talking about MAGI, okay? I don't want to think I'm saying it wrong, but it's just easy to say AGI than Maggie to me, all right? So if you hear me, bear with me, all right? And accept it as an old guy's decision. All righty. So if the AGI is posed, let's say is 550,000. All right, the 500,000 is the threshold. It's over by $50,000. So 30% of $50,000 is 15,000. So the 40,000 would then be reduced by the 15. So for 2025, this taxpayer's SALT cap would be $25,000. Okay, um, at 600,000, it's all gone, not the entire salt, but what happens at 600,000, the big benefit is gone, so you're back to 10,000. It never goes less than $10,000, regardless of how much income the person has. All right. The last bullet on the salt cap is relatively important for some folks. There was a notice 2020-75 which allowed these pass-through, I don't want to say gimmick, that's not the right word, but the pass-through workaround is a better word, that enabled people to sort of take advantage of their entity and be able to pass along a credit that would, on state taxes, that would get away from the $10,000 SALT. When the House did the bill, I believe they wiped that out, the ability to do it. When it went to the Senate, it was reinstalled, so there is no difference. So those of you, for example, in New York, I have a client like with a $22,000 credit that comes from this SALT cap. She would have been out if the House bill would have passed, but there was no change to that. All right. And I also will mention to you that the $500,000 phase out, that is also adjusted for inflation on a 1% basis. So next year it'll be 500,000 and 50,000, whatever the number is. All right. All right, Jeff, how about our first poll question? And I always thank Jeff. I don't know what your folks feel about poll questions. They there to take attendance, and I appreciate Jeff's cooperation and just giving us yes or no answers so we can go along. All righty, let's continue on page 3. Let's take a look at the Section 129 Dependent Care Assistance Program. As you are well aware, $5,000 is the cap that a taxpayer currently is able to defer from their gross income to use for dependent care. That, effective for 2026, has now been increased to $7,500. All right, if you're married filing separate, you really, now remember, typically, if you're married filing separately, you are not eligible for the dependent care credit. There are some unique circumstances which would allow that. We're not going to go into that today. You all know from your previous tax work. But that 7,500 would be cut in half for those few married filing separate people who might be eligible. The child and dependent care credit is the next one. You know, your Form 2441. It raises the credit. Currently, the credit, the maximum is 35% of the eligible expenses. It gets raised to 50% as the maximum. There is some decrease in that based on your AGI. What happens is, and if you look at the second bullet there, the rate reduces by 1%, but not below 35%, for each $2,000 that the taxpayer's income exceeds $15,000. So $15,000 is the 50% level. Everything after that starts dropping down by 1% for every $2,000. But unless you reach a higher level, which we'll see in a minute, it stays at 35% for a good portion of time. I have it there for you, and it looks strange, but between $43,000 and $75,000 of AGI for a single person, and double that for a married filing joint, 86 to 150, that rate of 35% will be in effect. All right. After those income thresholds, it starts to go down again, but never goes past 20%. 20% is the base. This year's 20% is the base. The maximum was 35. It's going from 25 to 50 with a large block still at 35%. And this new regimen will start in 2026 on 2026 tax returns. You know, some of this stuff starts when you prepare the 2026 return, but I think some of this is important for you when you do your client's 2025 return, explain to them. Or, for example, even now, you may want to send out a bulletin. If you know someone takes dependent care benefits and they have an option, typically it's in a November, early December period, you might want to alert them to the fact, if their employer hasn't, that it's now going from 5,000 to 7,500. I know one client of mine, she's married, and she sent me an email. She said, my boss says I can only go up to $5,000. My husband's boss says it can go up to 7,500. So one person was on board, the other person was not. Alrighty, the adoption credit, significant provision for 2025. As you're aware, for those of you that have had any taxpayers that have adopted a child, the credit was substantial but not refundable. Effective this year, 2025 tax returns, the the credit is refundable up to $5,000. So you will be able to, obviously this would be if the credit exceeded your tax liability, you'd be able to get it. The maximum credit is $17,280. If you have a special needs child that is being adopted, you can use that $17,280 in expenses, even if you didn't reach it. So if a taxpayer typically they had $12,000 in an adoption expense, 17 is the cap, but they only used the 12. If it's a special needs child and you spend 12,000, you still can use the 17,280. After the $5,000 refundable credit, if there's anything left, the credit can be carried over to 5 years. But notice on the bottom of page 3 in that last bullet, the cap, the amount that you can carry forward is capped at the unused amount of the credit, the non-refundable portion. So any credit carrying forward for this year would be $12,280, which is the 17,280 minus the $5,000 refundable part. Okay. Jim or Emily, do we have any questions there?
Frank, there's just one question with respect to the child and dependent care. And to tell you the truth, I can't remember the details here, but there's a question asking about the
Yeah, I
$3,000.
believe Steve, it's correct. It's still $3,000 per child, and with a maximum of $6,000 if you have two children. That didn't change to my knowledge.
Thanks, Frank. We are clear right now.
Okay, thank you. On page 4, let's take a look at 529 plans. 529 plans are, to me, one of those golden things that you can't go wrong with, but they've been making changes in 529 plans over the past few years, and a couple of years ago, they enabled taxpayers who had 529 accounts for their children to use the distributions for secondary and elementary private schools for tuition. All right, so if your child went to a parochial school or a private school and you had a 529, you could take money and have it as a qualified distribution simply for tuition. But now what OBBBA did is it extended the benefits greatly that you can take distributions and have them be qualified expenses. Understand, very top of the page, these expenses, this expansion started on July 4th, 2025. No, it was not to celebrate the Declaration of Independence or anything like that. This is the day the bill was signed, July 4th. So anything after that. So you may have to do a little bit of due diligence if you have taxpayers that are availing themselves of this or make expenditures. There is a difference. Prior to July 4th, tuition only. After July 4th, look at the entire list that's on page 4. Tuition, curriculum, books, other education materials. You can use a 529 distribution as a qualified expense for tutoring or educational classes in one of these learning centers, all right? There are some requirements that you can see there. The tutor has to be licensed as a teacher, has taught in an educational institution, or as a subject matter in the relevant field. You can't have your uncle come over and say he's a tutor or she's a tutor and you take an expense. It can't be a related party, okay? The fees for standardized tests. So if a child is taking the SAT or the ACT, some of those expenses can add up. This now is going to allow, remember this is for 2025, after July 4th, this will allow a distribution from a 529 plan for it costs $75 to take SAT class, I don't know what it costs, but if it took that, you can have a qualified distribution. May make your job a little bit more complicated because now you're looking at more possibilities for this. Tuition and fees for dual enrollment. When it means says dual enrollment is you may have some clients whose kids are in high school and they are taking a college class or they're taking a class in conjunction with a college for college credit. That's what they mean by dual enrollment. So if it costs the taxpayer $300 for a class that's going to get university credit, that $300 is now a qualified expense for 529 plan effective July 4th, okay? Starting next year, there's a limitation of $10,000 on this distribution. There's not a limitation on 529s in general, but for the secondary and elementary school, there was a 10,000. This is going to $20,000 in 2026. So this is some place if you have taxpayers that have children in parochial or private school, this would be a good thing to talk to them at tax time this year and explain to them that they have the ability to take more money out and to spend it on more things. All right, what's a really neat thing is the second part on page 4, and this is a new section, new subsection, I should say, that was added to section 529, and it's 529 subsection F. And what it does is it refers to what is called qualified post-secondary credentialing expenses. Now, what does that mean? It means that if you're an EA, you may probably use a 529 plan for your continuing education. All right. So if you look on the bottom of page 4, the expenses are tuition and fees and so on for a designated beneficiary in a recognized post-secondary credential program. All right. Fees for testing, if such testing is required to obtain or maintain a post-secondary credential. Fees for continuing education, if such education is required to maintain a post-secondary credential. Well, what's a post-secondary credential? Let's look on the top of page 5, and there it is. The term recognized post-secondary credential means, and I cut some of the code out because I don't think some of it was relevant to our discussion today. But let's take a look. This is in paragraph 3 of subsection F of 529. It says it's any post-secondary employment credential that is industry recognized, or, and C, any occupational or professional license, issued or recognized by a state or federal government, and any certification that satisfies a condition for obtaining such a license. So it seems to me, based on that language, that continuing education, renewal fees, that all those types of things for not only enrolled agents, but certified public accountants, certified financial planners, and things like that are going to be eligible. Now, I don't know if you want to go to the extent of opening up a 529 plan for it, but some people may, say down the road, why don't I do it? Why don't I put, a couple $1,000s in? I'm going to take continuing education forever, and you might be able to take advantage of this. So give it some thought. All right. The new sections is effective starting in January 1, 2026. So give some thought to perhaps opening it up. And, obviously you can't take any tax deductions. I don't know what New York State's going to do in a 529 for this, if they put any restrictions. New York, and I don't know other places, but New York does allow. I don't know if there's going to be any restriction on for this, but certainly the earnings you can, rather than put a couple $1,000 in, or a few $1,000 in a savings account, paying interest, taxes on the interest, this might be something that is beneficial to everybody. All right, Jeff, if you wouldn't mind, give us another poll question, please.
Frank, while they're answering the poll question, there were a couple questions just about New York State
Okay.
performance. Thanks.
Thomas, I don't know if New York I haven't said anything on this. I will put a plug in for, I believe on January 14th, NYSSEA will have the Ultimate New York, but right now I don't believe there is anything that
Yeah, at our
has
conference,
been in effect. Let me put it that way. Okay.
at our conference last week, Chris Meisland, who's the New York State taxpayer advocate, was asked, and he had an excellent presentation. I hope next year more people will take advantage of it. But he was asked about this, and he said it is to be determined. He expects they will follow, but to be determined.
Okay. As you're well aware, New York sometimes conforms, and Jim gave us good information. At this point, from a authorized rep, there's nothing that can be said. All righty, let's go over to page 5, and let's talk about charitable contributions. All right. Section 170P is reinstated, and what Section 170P did, that was the one where you had the $300, $600 above the line. That was above the line 1 year and below the line the second year. So the 170P was below the line, and it's going to continue to be below the line. Now, what do you mean by below the line? Remember before I mentioned AGI? A taxpayer, if they could, would always prefer to reduce their AGI almost universally, because so many things are based on your AGI. Your AGI goes down, you get more benefits typically. So if you can reduce AGI, that's called an above the line deduction. If you put but that's above the line, all right? And it requires that it comes from a section like Section 62 in the Internal Revenue Code. But other deductions are below the line, meaning they come after AGI, and what they do is they reduce taxable income. So what Section 170P is a below the line deduction that is going to start in 2026. And instead of bringing back the $300 and $600 ability to take a charitable contribution or to deduction for charitable contributions without having to itemize, those numbers go up substantially to $1,000 and $2,000. So when you're dealing with people this year's tax return, you might want to tell them that if they make further contributions, that they have the ability to get some benefit out of it, as they had previously. The 170P was, I think, there. What was it? It stopped in 2021, or it was in 2021, and it only lasted a year, and then it went away. Now it's permanent. Now let me just say to you what you might want to tell your people when you meet with them this year in preparation for that. This is not a giveaway. They need some evidence. Don't jeopardize yourself just putting $1,000 down or $2,000 down. Tell them next year you need to bring me your receipts or your checks or whatever, or send them to me. All right. But it is, all charitable contributions do require documentation, whether it be a canceled check or receipt. The $250 rule and all that, but understand that's what this is going to do, all right? For taxpayers who do itemize, there is something new that's going to be introduced starting next year, and it's going to be a floor that and God only knows how they come up with this stuff, but there's going to be a floor of 0.5% of your AGI. If you take a look on page 5, it's about the 4th bullet down. This is the first time for charitable contributions there's been a floor. We've had floors, of course, on itemized deductions, but it's going to be 0.5% of AGI. So if you have $1,000 in charitable contributions above and beyond what you've already taken under 170P, you'd have to reduce that by $50. All right, because it's 0.5%. And so instead of 1,000, you'd now be looking at $950 and the rest of your charitable contributions. Also, what they did was they made the 60% of AGI that you can take in a given year. If you remember, it used to be 50% for a long time, and then I think during COVID they went to 100% for 1 year, and now it's back to 60%. That 60% was made permanent. If a taxpayer exceeds the 60%, in conjunction with this point half of 1% floor, there are some ordering rules as to how you apply it. We're not going to go over that today. We have more work to do. That's going to be for 2026. But I want to point it out to you that they've thought about what happens, because not everyone gives cash. Some people may give capital assets, and they're all governed by that 60%. Sometimes there's a lower threshold depending on the nature of what you gave. But for 2026, the important thing to keep in mind, tell your taxpayers now, there's going to be, for non-itemizers, the $1,000, $2,000 ability to take a charitable contribution deduction. All right. The last 2 bullets on the bottom down there, if there are any carry forwards coming from earlier years, then there will be no impact on that. And this does not impact a QCD. The QCD is the qualified charitable distribution, which you can take from your IRA. All right. There are a couple of things we'll talk about on January 7th about that. I don't want to give away advance information. All right. How's that sound? Okay. On the next page, on page 6, not going to talk too much about this, but I do want to alert you to it because it's going to start in 2027. All right. It's a new tax credit for contributions to scholarship granting organizations. If you have an organization, I don't know whether it's going to be a PTA or things like that, or the Kiwanis Club, or lots of organizations like Kiwanis, Alliance. They do give scholarships, so they may qualify as one of these sponsoring organizations, and there will be a credit that for taxpayers who contribute to those funds up to $1,700. So if I'm a taxpayer and I see a fund that gives scholarships to kids, let's say it's legitimate, not any private inurement, just to a small group, and I make contributions to that, there's going to be a $1,700 credit for me down the end of the road, assuming that I gave that much money. There's a new code section, 25F. As I said, we're not going to go over it too much. I just want to alert you to it. And what they also did is they enacted another code section, 139K, which specifically says that if you're a student and you get a scholarship from one of these organizations, then it's exempt from gross income. As you're well aware, scholarships can be taxable depending on the situation, depending on how big it is and your expenses. And we're not going to talk about that now, but this specifically says these scholarships would be exempt from gross income. Or as I said, it's 2027. There's probably going to be some state involvement on this and administrating these things. Further guidance is obviously needed, but keep that in mind. The last bullet on before we get to our poll is qualified residence interest. As you're well aware, what TCA did, they made the $750,000 threshold for qualified mortgage interest, all right, residence interest. Um, there's no more equity interest. It's got to be on acquisition debt. That was made permanent. But what it also did was they reinstituted the mortgage insurance premium, which had been temporary. I think the years there were from 2018 through 2021 was the last um, ability to do that. The mortgage insurance premium has been come back. It is limited, of course. It always has been limited. The threshold starts at $100,000 for taxpayers. The mortgage insurance premium is going to be considered as qualified residence interest. So that would be included in your $750,000 as far as I can see, because they're both qualified residence interests. There's no separate listing. It may be on a tax return, they may indicate it so you can show how you came up with the number, but mortgage insurance premium starting next year will be determined to be qualified residence interest as if it was done on acquisition debt, okay? All right, Jeff, how about our next poll question?
Frank, do you want to take a couple questions?
Yeah, if I can.
All right, so Stephen asks, is 170p available to itemizers or only non-itemizers?
Yeah, Henry is correct. And as I indicated before, I understand that, but AGI is much easier to say. Is it 170p available to itemizers? I believe, Steve, it's only for non-itemizers. You would have to use if you're going to itemize, you would have to use well, let me see. Yeah, no, I'm going to let me rework that. Let me say, Steve, I'm not 100% sure. So I think it was designed only for non-itemizers, but I don't know if there's any specific restriction. But right now, I would say if you itemize, it's not available. But let me be equivocating on that. I'm not 100% sure. If you itemize deduction, Rebecca, is always below the line, um, but you can have above the line and below the line the same return. I'm not 100% sure what you're looking at. All right, on page 6, let's go back. Let's go continue on our wagering loss limitations. Um, TCGA created special rules for gambling. They said gamblers are not allowed, whether they're professional gamblers or personal gamblers, you cannot have losses exceeding gains. All right. That was made permanent. And then in addition to that, what TCAJ did is put a limitation on gambling losses. If you look at the bullet there, losses from wagering transactions, they don't call it gambling, all right, is 90% of the amount of such losses. What was interesting about this is after they passed it, there were some senators that said, "Oh, I didn't realize this was in the bill." And like within 14 minutes of the bill being signed, someone tried to introduce a new legislation taking this away. I don't know how far it's gone, but basically, this is the sad thing about our politics. I don't care which side of the aisle you're on, these bills are passed with nobody reading them, But in any case, you're limited to 90,000. And in the box on page 6, I mentioned to you whether it's fair or not. There's no fairness in the tax world. You all know that. If a gambler has $100,000 of winnings and $100,000 of losses, the winnings go on Form 1040 and the losses go on Schedule A, but you are going to be limited to only 90%. So if let's say you have $100,000 of gains, $100,000 of losses, you're only allowed to take $90,000 in losses. So you would have a $10,000 gain, and so you'd pay tax on $10,000, even though you didn't have an accession to wealth of $10,000. It's not as drastic as it may seem, though, because a lot of non-professional gamblers aren't so lucky to break even. So I gave you a second example there. Same thing, $100,000 of losses. You're limited to $90,000, 90% that you can apply on your tax return. But if the person only has $85,000 in winnings, the 85 can be reduced by, and of course on a Schedule A, it's going to be 85, not 90. But you all understand what I'm driving at. For that person with $85,000 in winnings and $100,000 in losses, their winnings can get fully wiped out. Okay. All right. On the bottom of page 6, it says the gross income exclusion for student loans discharges. The temporary TCAJ, which allowed for the exclusion of income because of death or permanent disability, was now made permanent. On the next page, we mention about the American Rescue Plan, which was often a much more advantageous situation with student loans, and they provided an expansion of the loans. Basically, any student loan discharge was forgiven, as it was not included in gross income. OBBBA lets that provision sunset expire, I should say, I guess, expire on December 31st, 2025. Any exclusion after 2025, starting in 2026, and this now is only going to be for people with disability or death, a Social Security number must be provided on the tax return where this exclusion would be claimed, okay? All right, educator expenses. This is a kind of interesting, the educator expense is going to be, can be both an above the line and a below the line. I know Steve asked that question before. I wasn't equivocating on it. I think it's only for non-itemizers. But in educator expenses, it's for people who itemize and people who don't. All right, you can take the above the line, and the reason what happened was we all know the 2% deduction, which is in Code Section 67, TCJA eliminated for that 5-year period. No miscellaneous itemized deductions subject to 2%. OBBBA made that permanent. It's gone. But what they did do is they introduced a new educator deduction in addition to, how am I going to say this? The Code Section 62A, where the educator deduction is in existence, that the $300 ability to deduct, that's still there. That is above the line, all right? It reduces adjusted gross income. And in addition to that, they said expenses which are above your above the line deduction are now going to be a new miscellaneous deduction that is not subject to the 2% rule. So if you think about a Schedule A, when they have miscellaneous deductions, you know, I think that you have to identify them, but you have gambling losses and unrecovered basis in an annuity, that kind of thing. There's going to be a new one, and it's going to be educator expense as a miscellaneous deduction, not subject to the 2%, all right? And it's in code section 67 where the miscellaneous deductions are. All right. I don't know if you've ever looked at the code, how it goes, but code section 67 says everything here is subject to the 2% rule, except boom, 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 boom. It's got a gazillion exceptions. Like, for example, state and local taxes are not subject to the 2% rule. You all know that. But now there's going to be a new one there, and these are the educator expenses. There's no specific dollar limitation on it. Let's suppose a teacher was, you know, you always got to be careful with ordinary and necessary business expenses that they will call for, you know, not just the goodwill out of your heart. So there may be some charitable contribution conflict here. Some people always have spoken about that. But there's no line on it. So if a teacher went out to buy a computer that was needed in the classroom, then that expense would be part of this new miscellaneous itemized deduction. The good news is for those people who don't itemize or don't have large ones, but have, you know, in that 300, whatever that number is for their expenses, you know, $300-400, and they're capped at 300 on the front of the 1040. But now they broadened who's eligible for that. Not only the classroom teacher with the 900 hours, but people who coach. You know, there was a provision you couldn't have any kind of athletic expenses. But if you're a coach, you often buy supplies or a new soccer ball or whatever. I mean, the schools typically provide these things. But those kinds of expenses that a coach may have, you know, I don't know if the occasional pizza party is going to be a valid educator expense, but sometimes they may reward their students, possibly could fall into that. But understand now that coaches, athletic administrators, and that type of person are eligible for the above the line $300 deduction, assuming, of course, that they have expenses. You know, that's part of your due diligence, all right? And let me just mention about the casualties quickly. TCAJ provided the rules. Those rules were made permanent. The only thing that is worth noting here is that the disasters that qualify for the casualty losses will now include state-declared disasters. So it may have, for example, if Long Island had a hurricane and it was just impacting the lower portion of the state, the governor could declare a state disaster, and it would fall under the ambience of the federal declared disaster areas. Same type of things, whatever was good for one will be good for the other. The only thing I'm not sure of is in the language it says there, it says that the Treasury Secretary, in conjunction with the state governor or government, I don't know exactly what the phrase was, will talk about this before. Now, I don't know whether that's going to be an obstacle or not, but the basic thrust is that state disasters declared by a governor will now fall under the Section 165 rules for casualty losses. All right, Jeff, if you would, please. How about one more?
Right. Just before we move on, there's a couple of people asking when the gambling loss rules come into effect. Is it this tax year or is it
For
2020?
the PMI?
Yeah.
Yeah, that's going to be effective in 2026.
Okay. Thank you. And just to confirm, the new educator deduction, my understanding is, or from your notes, it says it has no phase out. Is that correct?
Which has no phase out?
The education expense.
No, the educator expense, there is no dollar limit in the law, all right?
Okay. All right.
On
Thank
the
you.
on the mortgage insurance premium, there's no escrow there. I don't know if that's the correct word, but people who pay mortgage insurance premiums have a separate stated, typically on the 1098 mortgage interest form. For 2025 returns, they are useless. For 2026, that mortgage insurance premium can be considered as part of the qualified residence interest, subject to the rule, the $100,000 rule. Gambling losses get reported on Schedule A. If you have a HELOC and use the money for investment property, probably yes, Darlene. There is a regulation there. The temporary regulations allow you to categorize. I don't know. I don't remember it, but you may have to make an election on your return. And that question is beyond the scope of what we're doing today, but it's quite possible that you can do that if you make an election to treat the mortgage as not a residential mortgage, but it's beyond what we can talk about today. Everything's subject to the phase out.
Frank, there's one more question here about,
Gambling is 2026.
there's a question relating to a person teaching religious
Yeah,
instruction.
that's a good question, Anna. I think they religious instruction. If it's not in a school, I would think no. If it's like a home thing, but whether there's any provision for that, I'm not 100% certain. I don't want to say yes or no. Right? All right. By the way, if to the Wranglers, if there are still questions left when we finish, I will stay around. So I want to keep going. So I'm not ignoring anyone's question, but we'll take them at the end if there's still more questions we haven't gotten to, okay? All righty, let's go to the bottom of page 7 to the itemized deductions limitation. You know, many of you were aware of the so-called PEACE, P-E-A-S-E. He was he was a congressman, and he introduced a 3% limitation on itemized deductions. TCJA excluded that for the year from 2018 to 2025. OBBBA permanently replaces that, but replaces it with a new limitation specifically directed to taxpayers that are in the 37% tax bracket. All right, this will start in 2026. This is designed for people in the 37% tax bracket, the highest bracket that there is. And if you look on the top of page 8, the second bullet explains what the limitation is. The limitation reduces allowed itemized deductions by 2/37. Where that number came from? It was designed to take the 37% and move it to the 35% threshold, okay? And that's why you get that crazy number. By 2/37 of the lesser of the taxpayer's total itemized deductions, or the amount by which I call it their adjusted taxable income. If you look at some early articles on this provision, they are wrong. You have to adjust the taxable income by taking the taxable income and adding back the itemized deductions. That's why I call it adjusted taxable income. So look at what number 2 says. The amount by which their adjusted taxable income, parens, taxable income plus their total itemized deductions exceeds the threshold of the 37% tax bracket. Okay? Here's an example. All right? I think the example will clarify because it looks confusing, but the example I think is relatively simple. I have Ed and Tina, they're married filing joint, they have an AGI of $900,000 and a total of 140 in itemized deductions, resulting in a taxable income of $760,000. All right? They had no other below the line deductions. All right? I'm used for this example the current 37% threshold. It's $751,600. That's the threshold to go into the 37% for 2025. Okay, but I wanted to use an example. So the reduction is 2/37 of the lesser of A, the itemized deductions, which are 140,000, or the amount that exceeds that 751,000. So you take the adjusted gross taxable income, which is the 760, plus the 140,000, which gives me 900,000. Take away the 751,600, and I get $148,400. Which is the lesser of the two? Is it A or B? It's A. It's 140,000 is the lesser. So what you do is you take 2/37 of $140,000. This is all laid out, so I hope you're looking in the box. And that's $7,568. That's the excess that you will have to subtract from the itemized deductions. So the itemized deductions were $140,000. We now reduce that by $7,568, and the deductible itemized deductions will now be $132,432. All right, that makes sense? I mean, I'm not saying it makes sense tax-wise. I'm saying it makes sense arithmetically wise. All right, that's what you have to do. All right, you take the 2/37 of the lesser of the itemized deductions or the adjusted taxable income, the excess over the threshold. That $751,000 is going to be higher in 2026. If you come on January 7th, I got a different example with the new number. So, but for now, that is the number. That's the process. And I think if you understand the process, the numbers just will be okay. All right. And they did specify that this new limitation is not bearing on any calculations for Section 199A, those calculations that fortunately your computer does all the work for you, okay? All righty, let's take a look at bonus depreciation on page 8. All right, the additional first year pension is made permanent. The bonus rate is increased to $100,000 for property acquired after January 19, 2025. That was the day of the inauguration. The taxpayer may elect a 40% bonus instead of the 100. Please, if you have a printed handout or you can make a note, I didn't put it in, I realized it too late. That 40% is a transitional rule only for 2025. The current bonus depreciation is 40%. We all know that right from last year. It was going to stay, but now it's got raised to 100. But for this year, the transition, the taxpayer doesn't have to take the 100. If they opt for bonus depreciation, they can take the 40. All right. So if you look at the last bullet, for property after January 19th, and notice it says acquired, it doesn't say placed in service. All right. The taxpayer has 3 choices for this year. All right, transition rules. So please write that down. This is not permanent. All right, they can elect out a bonus depreciation. They can take 40 or they can take 100. Of course, you all know that you can elect the 100% is going to be the default, but you can opt out, and there are times you want to do that. And then, of course, you also have the Section 179. Some people want to debate whether bonus was 170. That's a different topic, way beyond what we're talking about here. I just point out to you that the Section 179 has a new permanent base. The permanent base is $2.5 million. It will be adjusted for inflation, and the threshold at which you start to take away from that 2.5 million is that if your assets, that the qualifying property that you purchased exceeds $4 million. Both of those numbers, the 2.5 and the 4 million, are adjusted for inflation starting in 2026, but those numbers are firm for 2025. Okay? On the top of the next page, number 9, the student loan payments as qualified educational assistance. A few years ago, an employer can have a program where the employee can take $5,250, which is the maximum, in college tuition assistance. They extended that to ability to pay a student loan as part of that program. That is now made permanent, and it will be adjusted for inflation starting in 2027, and that will be in multiples of $50, excuse me. All right, so that the Section 127 provision is now made permanent. And the last thing before we get to a poll is the ABLE accounts. There's some significant stuff here. There are increased contribution limits in an ABLE account. They were made permanent. Typically, when the ABLE account first came out, it was linked solely to the gift tax exclusion. If the gift tax exclusion was X dollars, ABLE contributions were X dollars. That has been broadened. If you have an ABLE account, all right, achieving a better life, I forget the last thing, but it's for people that generally have some handicapping conditions and looking to, increase their ability when they get older to have a better life. And that's what it's all designed for. They increased that to not only the gift tax exclusion, but the lesser of the poverty level for the given year for a single person or the person's earned compensation. The poverty level is, I think it's around 19,000 or 17. Don't quote me on it. Whatever it is, it's the lesser of the poverty level and the taxpayers earn compensation. I had a young lady 2 years ago put $31,000 in an ABLE account because she was able to take advantage of this. It's permanent. The one other thing I want to mention to you is the Savers Credit in Section 25B. Contributions to an ABLE account are going to be forever, at least permanent for now, as available from the 25B. The last year that the Savers Credit is going to be in existence for other contributions like IRAs or 401ks is 2026. Starting in 2027, and we're not going to cover it today because it's beyond what we're trying to accomplish here, is going to be the Savers Match, which is in Code Section 6433. It's a whole new program, all right, and we'll talk about that next January when 2027, all right? All right, Jeff, how about our poll question, please? I see that poll question. For $95, everyone should join if you're not a member. Remember, Section 162 is ordinary and necessary business expenses, allows you to have a deduction. So given a typical person, it's costing you $60 out of your pocket to be a member of NYSSEA, the best affiliate in NAEA. All right, let me just go to, there's a couple of questions I'm gonna, if I use a home equity loan for a home improvement, is it still not deductible? No, if it's a home equity, if you use a home to substantially improve your home, it's not a home equity loan, it's an acquisition debt. So acquisition debt is habit. The casualty dates made the PCJA is going to 2025 and was made permanent, so it's forever. All right. It's charitable. Yes, the charitable deduction is separate. You would calculate your charitable contributions, and on your Schedule A, you would take then all your itemized deductions, and they in turn would be subject to the 237s. But remember, only for those in the 37% tax threshold. Your typical taxpayer, 22, 24%, not impacted by that at all. All right, let's go to page 8 for our 4 presidential priorities. That's what they were called in the bill, the presidential priorities. These are all, political promises, and sometimes the promises weren't kept as well as people thought, but in any case, making no judgment on any of that, these are 4 below the line deductions. All 4 of them are temporary. All right. They are only for the period from, 25 to 28. All right. And after that, whether Congress will continue them or not is subject to question. All right. The first one is the personal exemption deduction for seniors. This is found in Code Section 151. We're not, but there's the rule on the bottom of page 9. It says, in the case of a taxable year beginning before January 1, 2029, so 25, 26, 27, 28, all right, qualified, there shall be a deduction of an amount equal to $6,000 for each qualified individual. Understand something, folks. This has nothing to do with Social Security. Social Security is taxed in Section 86 of the Internal Revenue Code. There was absolutely no change to Section 86. All right? You don't have to be on Social Security to qualify this. If you're on Social Security, you may not qualify for it. It depends, all right? So there's no connection with Social Security. During this 4-year period, the $6,000 is not going to be adjusted for inflation, or it's $6,000 throughout. On the top of page 10, a couple bullets there we want to take a look at. Who's the qualified taxpayer? Any taxpayer that has attained the age 65 by the end of the tax year. All right. Married individuals must file a joint return. You must provide Social Security number for the qualified individual. It's based on AGI, Maggie, all right. It's going to be reduced by 6% over the threshold numbers. For a single person, it's $75,000. For a married filing joint, it's $150,000. All right. At 6% over those numbers, start reducing. All right. So look at the example that I have in the box there on page 10. Jim is age 71. He collects Social Security. Vicky is age 68. She does not collect Social Security. Social Security is irrelevant. I just put it there to illustrate. Are both of them 65 at the end of the tax year? Yes. So what's their tentative senior deduction? It's $12,000. But their AGI is 180. So what we have to do is look at the threshold of 150. 180 is $30,000 over the threshold. Everybody with me? And 6% of $30,000 is $1,800. So what you do is you take the $12,000, you subtract the 1,800, and this will be their deduction will be an additional 10,200. Now this deduction is in addition to their $31,500 standard deduction, and is in addition to the extra, what is it, 1,850 or whatever the number is, I don't escape, for an individual 65 or over. So it's all piled on top. This is going to be presented on a new schedule, a Schedule 1A. We will cover that schedule on January 7th when you're gearing up to prepare tax returns. And it will be with the other three below the line deductions in this presidential priority thing. All right. So basically, it's a increased deduction for 4 years, subject to income thresholds, no relevance to Social Security. All right, the second presidential priority with no tax on tips. There was a new section added to the Internal Revenue Code, Section 224. And once again, it's temporary. It's only for customary and regularly received tips prior to 2025. The tips must be voluntary and determined solely by the customer. The taxpayer must have a Social Security number, and if they're married, they must file a joint return. All right. Tips earned in an SSTB, you know that back from the old days of 199A, do not qualify. All right. The phase out starts at $150,000, $300,000 for a married couple. And if the phase out is $100 for every 1,000 you are over that threshold. Important point, W-2 forms are not changed for 2025. Some people who work in a restaurant already have tips, and have the wages on a W-2, and then it says Social Security tips. Not all Social Security tips may be qualified. You're going to have some work perhaps to do here. You as a preparer, just don't take the obvious. You may have to ask some questions. The employer is supposed to tell the employee which tips are qualified. In this transition year, they can use an appropriate statement, whatever that is, all right? But could be a problem. Those of you who prepare do bookkeeping or accounting for small restaurants, you may have more of a burden than anybody else, for all we know. On the bottom of page 10, Treasury was required to give a list of occupations that were involved with tips. And if you look on the bottom down there, they did that. They have the Treasury Tipped Occupation Code. The acronym is TTOC. On the top of page 11, if you look at, I listed, you notice these are the codes. They go from the 100s to the 800s. This is not the entire list. I wanted to give everyone a sense of what's involved here. You notice they broke it up into 8 different categories. And, beverages would be bartenders, cooks, dishwashers. The dishwasher, you may say, well, who's tipping a dishwasher? But remember, in a restaurant, the waiter shares his tips with some people in the back room, So it's going to be an issue. And I just gave you an example about halfway down the page, a pet caretaker. They're both in personal services in the 500s. They have a TTOC of 506, while nannies and babysitters who take care of humans have a TTOC of 508. The 2025 W-2s have not been changed, but the draft W-2 form for 2026 does have a place for qualified tips and qualified overtime, all right, which we'll talk about in a second. There is a new box 14B that will be for qualified tips. There are also codes that are going to be on there in box 12 for use. The interesting that the non-employment, the NEC form, the 1099, also has a box for qualified tips, and some of us are worrying about how does a self-employed person on an independent contract, I don't know, but it's there. We'll worry about that next year. But be aware, these TTOCs are going to be used in the future. Okay. All righty. The thing I wanted to point out to you is on the bottom of page 11 here. The IRS proposed regulations there, and you can see it cited there, which gives a number of examples that you need to be aware of. I would advise you. I'm gonna talk a little bit about it in a moment, but I would advise you to read those regulations. They are readable, all right, because they have a lot of examples in them that will illustrate the nuances. You know, one of the things, and everybody and his uncle has used this example because it's in the regulations, the proposed regs. You're not allowed to have qualified tips if you're in an SSTB. But what happens, and look at the example there, it's almost down near the end of the page. What happens if you have a piano player, an entertainer? He's an SSTB. He works in a hotel, though, in the the lobby bar. People give him tips, but he's an employee of the hotel. He qualifies for, or she qualifies for qualified tips because they are an employee, and the entity employing him or her is not an SSTB in and of itself. Hotel is not an SSTB. So those kinds of nuances are crazy. So for this year, keep in mind the $25,000, the threshold, they got to be qualified tips. And God help us if the employers don't get this basically right. All right, but you may have to use your due diligence. Jeff, how about a poll question, okay? Oh, I'm sorry. Before Jeff gave the poll question, I wanted you to read the question in the box. And it says, many restaurants to aid wait staff provide an automatic 18% gratuity will be added to the check for parties of 6 or more. Are these tips qualified and eligible for the deduction? Jeff, is it still up there? Because I closed mine out, the poll question.
Yes, it
Can you put
is.
it one more time?
Still there.
All right. I apologize for not saying the question before I asked Jeff to do the poll. My mistake. I'm sure most of you have answered no, because that gratuity is not voluntary, it appears. In these regulations, the answer really, in my opinion, is it's more of an it depends rather than an absolute no. Because in the regulations, the proposed regulations, there are crazy nuances. For example, if in that situation, if you get the bill and all it says is 18%, the IRS says it's not qualified. If you get the bill and it says 18% is added, but do you want to change it? I mean, I'm paraphrasing what the examples are, but in the interest of time, I want to, if you can change it and make it, add something on. So let's suppose it's 18% on the bill, but there's a line that says you want to add something on, and you add on 2% to make it 20%. Well, the IRS says that the 18% is not qualified, but the 2% is. Seems to me, if you made that option to make it 20%, you volunteered to make it 20. But those are the kinds of things that are going to drive you crazy. You got to read those proposed regulations. They also have some weird stuff. You go into restaurants, like I think they do this a lot in places like Applebee's or TGI Fridays, where they have those iPads. They come around. They call them point of sales registers, and they, here's your bill, and then they give you a screen that says tip 15, 18, or 20. If you type, let's say you check 15, is that a qualified tip or not? According to the IRS, no, because you didn't have an option. It was mandatory. You had to check something. If the POS says 15, 18, 20, no tip, then you check the 15, now it's qualified. All right. So it could be really, really an issue. In the interest of time, I don't want to say any more about it, except please, if you Google that regulation, just put it in your browser and you go about halfway down, after all the preambles and everything, you will see the examples there. And they are kind of illuminating. Uh, Emily and Jim, I'm going to hold off on some questions for a couple more minutes, and I'll come to, but I won't ignore anybody that is there, okay? All right, folks, let's go to the top of page 12 for the third of our priorities, and this is no tax on overtime. Another new section in the Internal Revenue Code. This is section 225. And this is once again very parallel with one exception. This is temporary, it's for 4 years. This one is a deduction of $12,000, $12,500 in overtime compensation. Unlike the tips, this can be changed based upon filing status. In the tip one, whether you file as a single person or a married filing joint, the $25,000 is the cap. If for the overtime, it's basically $12,500 per person. So if you're a joint return, you can do 12.5. Your spouse can do 12.5. You can bring it up to the $25,000. That's the difference in 224 and 225. The overtime must be required under the Fair Labor Standards Act. That sounds like a technical thing, but it's a real concern. You'll see in a second why I say that. Same phase-out rules, same thresholds. The only thing you got to understand, and your taxpayers may not understand, but what's the definition of qualified overtime? So I have an example in there, a simple example. You make $20 an hour. You get time and a half, so your overtime pay is calculated at a rate of $30 an hour. But only the $10, the excess over your what they call regular rate of 20, is considered qualified overtime. So if a person works 10 hours of overtime at the $300 and makes $300, they're thinking in their mind, no tax on overtime, what's going to come off? $300. But no, it's only the $10 per hour. So if they work the $10, 10 hours of overtime, their deduction is only $100. Everybody understand that? I'm sure many of you have been made aware of this. It was a big discussion, but the IRS has put that out. Once again, as in 224, if you're married, you got to file a joint return. You have to have a social security number. ITINs will not work here. Same rules with the W-2. The employer is going to have to provide information. But very significant, I want you to look at the box for a moment on page 12. Some of you, like, for example, I live in New York on Long Island. I have workers who work for the Long Island Railroad. You may have workers who work for the MTA, or those of you in other geographical areas may have rail workers. Rail workers do not qualify for this because their overtime is not determined under FLSA. Their overtime is determined under the Railroad Labor Act. And their overtime, I don't care how much they have and what they have, is not qualifying for this deduction. I point out in here the crassness of this is that the Senate knew about this before they passed the bill. There was an amendment to change it so that it would not just be FLSA, but it would also be RLA. The Senate chose to not take the amendment up. And so railroad and some airline workers, I'm not sure the pilots, but some of the airline workers fall under the ambit of RLA. So be careful. You may have to explain to some taxpayers, sorry, you're not in the right profession, okay? But keep it in mind, it has to be under the Fair Labor Act. And not a lot of people have been talking about the railroad workers. And as I said, I have some of them, and I'm sure many of you also do. All right. And the last of the four priorities is their car loan deduction. This is a new paragraph in section 163. And this is also temporary. It's a deduction of up to $10,000 for what is called qualified passenger vehicle loan interest. All right. It's only available for vehicles or the loans taken after December 31st, 2024. So it starts in 2025, but not if you bought the car beforehand. Whether you refinance it or not, it's not going to count. It's got to be a new car because the first service has to be with the taxpayer who's claiming it. All right. The deductions, notice the threshold is lower than the thresholds for the tips and the overtime. The threshold for AGI is 100,000, 200 for married filing joint, and the phase out is $200 for every 1,000, whereas the other one was $100 for every 1,000. So keep in mind that this is significantly different, and more people may not qualify for it based on their AGI. A qualified passenger vehicle is basically anything that's got two wheels or less and it weighs under 14,000 pounds. So your pickup trucks, your SUVs, your motorcycles, all these should qualify. As I said, as long as they're under 14,000 pounds. The vehicles have to be assembled in the United States. They have to have a VIN number. Section 6050 AA, you see on the very bottom of the page, requires that information forms be sent to the taxpayer detailing the qualified interest. If you look on the top of page 13, what the IRS did is they came up with a new form to satisfy that requirement in the code section. And the form is called a 1098-VLI. All right, vehicle loan interest. That's what it stands for. And it's in a draft version. What the IRS said, they issued a notice, and this is also on the top of page 15. And it says, in notice 2025-27, there is transitional relief. They realize that not every banker or whomever does these Ford Credit or Lexus Financial Services or these things may not have the 1098 VLI available. So for this year only, you can take the interest based on, you notice they gave 4 different options: an online portal, the regular monthly statement, an annual statement, or any other similar means that will provide the required information. All right, so the loan is going to be, as I said, a little bit harder perhaps for some folks to accommodate. All right, Jeff, how about a question? Okay, we have a couple more topics. I think we can get through this in the next few minutes, all right? And hopefully we'll have some time for questions and everyone can depart on their way full of knowledge. All right. Okay, Trump accounts. Uh, I want to just give you familiarity with them. There's a lot of weird rules here. You can't fund one until July 4th of 2026, but there's going to be a pilot program that goes back in each. So let's look at it and see if we can understand what's going here. All right. Um, the new section was Section 530A, Trump accounts, which become effective after 12/31/25. Unless it's noted, these Trump accounts are gonna, there are some exceptions, but unless exception is noted, Trump account is going to be treated as if it was a traditional IRA, not a Roth IRA, a traditional IRA. And I pointed out there are numerous questions still in existence. It's going to require some guidance from the IRS. But a Trump account can be created for any eligible individual. Who's an eligible individual? It's a child who was under age 18 by the end of the tax year, all right, and has a social security number. That's an eligible, this is designed for children, all right? The accounts can be opened either by a parent, all right, or the government. There is provision in this code section, and also you'll see there's another code section coming up in the pilot program, which is all going to be on another page, that allows the Treasury Secretary to look at a tax return, and if he or she determines that the taxpayer has a child on it that's eligible, they will open the account for them. How this is going to work and how it's going to function, God only knows. But there is that provision that the Treasury Secretary can open the account if the parent fails to do so. All right. Contributions cannot be made until July 4th. They're going to be limited to $5,000 for the first 2 years, 2026 and 2027. All right. After that, they will be adjusted for inflation, and we'll have higher limits. If you look on the top of page 14, couple important points. One, the contributions have to be given by the end of the year, by the close of the year. Unlike an ordinary IRA, which you have until April 15th to fund, these must be funded by December 31st. There is no deduction. If you put money in here, even though it's like an IRA, there is no deduction under Section 219. However, contributions will give basis so when the distributions occur, right? The contributions have to be made into a specific eligible investment. Generally, the eligible investment has to be some type of index fund, no wild things. You know, Standard & Poor's Index 500, there are numerous firms which administer these funds. They have to have low investment expenses. So they're trying to make this profitable for the taxpayer who opens up the account. One of the things that's important that we need some more guidance on is employers can help fund the $5,000 contribution up to $2,500. All right, there's a new section, section 128, it's just in your handout, that allows the employer to put $2,500 into the account and not report it as gross income to the employee. That's a significant thing. At this moment, it is believed, this is subject to, this could be changed, that the $2,500 is included in the $5,000. That's the belief of most people right now. There are provisions that you can go over the 5,000, but not through the employer, but that stands to be seen. Distributions generally will not be allowed until the child turns 18. All right, it's not going to be. There are a couple of exceptions. They're on page 14. Basically, they're rollovers. I'll leave that to you in the interest of time to take a look at. General rule, though, once you have this account, there are no distributions until the child turns 18. When you take the distributions out, they're going to be taxed like an annuity, basically. All right, they're going to have basis in there. You know, like in the 8606, when you do a Roth account and you have that, or you have an individual IRA that has a basis and you recoup part of your investment. That's how this is going to be taxed. They say it's going to be taxed like 72, which is where annuities are taxed, and also under 408D, which is where distributions from IRAs are mentioned, all right? And as I said, as you take the distributions out, given those rules, part of it will be taxable, part of it will not be. Generally, what's going to be taxable? Only the earnings. All right, but they'll be taken out as if it was an annuity. You don't take out the earnings first, you don't take out your contributions first. It's taxed as if it was taxed as an annuity. An important point then on the bottom is that when in calculating your basis, if the money from the pilot program, which we'll talk about in 1 second, is involved, or the employer contribution, or it is anticipated that some states may actually contribute to these accounts, all right, any of those contributions do not increase basis. Lots of questions, folks. All right. And if you look on the top on page of top, I'll say it, on the top of page 15, this is the pilot program that was set up. It's in code section 6434. And basically what happens, what the thinking is, let's give these Trump accounts a jump start. The federal government will put $1,000 into every Trump account that's created for any child that was born effective, or the way they say it is after 12/31/2024 and before January 1st, 2029. So if you were born in 25, 26, 27, 28, in that 4-year period, you can get $1,000 put into your account tax-free. All right, and it's going to be as I said, a jump start. The feeling is that by jump starting it, people will start to contribute. One of the questions that's unanswered, is this the best investment for everyone? Maybe not. Maybe 529 is better. But if you're getting $1,000 for free and you have an employer who may give you $2,500, you'd be crazy not to open it, even if you never did another thing again. You know, and if you look at some of the runs that on time and money, you can, $1,000 will turn into like $17,000 by the time the kid gets to be 18. So do it, even if you think there's better options down the road. But having said that, the first contribution cannot be until July 4th of this coming year, 26, and there's a gazillion details which I can't help you with, but I want you to be aware of it because some of your clients are going to ask you about them, so at least you have a basic understanding of what's going on. All right, Jeff, how about our last poll question? All right, our last topic is on page 15. And this would be very quick. We'll run through this and then we'll take any questions that are left. And they deal with the new 1099K thresholds. If you look on page 15, It had been planned that it was supposed to be $600 for 2025. You know the ongoing 1099K thresholds. And it was planned for $600. What OBBBA did was it made retroactive that it's going back to the old before they started changing it, that you have to have $20,000 in transactions money and 200 transactions. That's a conjunction. You need both of them. Those are the new 1099K thresholds, which are the old ones all along. And what's significant on the bottom is the 1099 NEC and 1099 miscellaneous thresholds. You know, it's been $600 forever. I think it's 1954 that actually started it. And now it's going to, for 2026, it's going to be $2,000. So if you have an independent contractor, you pay them $1,500, you will no longer be obligated. And I'm saying you shouldn't, I'd say, but you're no longer obligated to send a 1099, all right? $600 is the threshold. And on page 16, you will note that those numbers are going to be indexed for inflation, all right? And it's going to be in multiples of 100. So at some time, you'll go from 2,000 right to 2,100. There's not going to be any intermediate. And the final thing is the Social Security numbers are now required on both the learning both the education credits, the American Opportunity Tax Credit, and the Lifetime Learning Credit, both require Social Security numbers. ITINs will not work for anybody involved in that, the taxpayer or the recipient, okay? All right, that brings us to an end. I got some questions here. So I still see a question here. David Silverman asked a question. By the way, David, good to see you. David is my hero. He has his intervention stopped EAs from having to pay $100 registration every year as part of their return preparer. So thank David next time you see him. Yes, David is still didn't change as far as I know. The grandfather $1 million is still there.
And Frank, the next couple of questions that are about tips, there's several kind of comments that all tie together.
I'm sorry, the tip questions, right?
Yeah.
All right, let me just run through them, all right? How we posting off tips are voluntary. The W-2 in the future should have qualified tips. And for this year, you're going to have to rely on the good faith of the employer. If it's an automatic tip, the regulations say it's not qualified. That's all I can tell you. The regulations, I urge you to read that regulations, all right? All right, and Henry has something there uploaded to the Google group. Looks like it's good information for penalty relief for reporting by employers. What about airport self-service tip? This is when you help to give a tip to the person that helps you. That I would expect would be a qualified tip because it is voluntary on your part. All right, and Amy just gave what I think Henry put there. Does this indicate that will most likely be available to self-claim? I would think that every tax preparer needs to do due diligence, and I think that's all I can say on it. You know, you're going to have to do it due diligence. Can a grandparent open up one? I think it has to be the parent, but I'm not going to be for sure, all right? The David's question, who funds the government, opens up with $1,000. After that, $1,000. The owner of the account, typically the parent, and I don't know about the grandparent, I really don't know. The government would open it up with a boost, and then after that, contributions would then be either by the employer of the or the person who owns it, or if the state government does it, as we said. All right. If an employer adds to, can the employee deduct? Yes, they will be able to do that as a business expense without inclusion in the employee's W-2. What's that 17? I don't know what that is. Buy a sandwich, both parents on it. I don't know, Jennifer. I would assume it might be somewhat like a 529 plan where there is a single person who is the owner, another person is the beneficiary, but I would assume that it would just be a single name. Emily or Jim, are there anything else that I missed there?
I don't see anything, Frank, but I would note that just about everybody has stayed on the line. So
Well, that's good.
kudos to you. Way to go.
I'll have to tell my wife. maybe a hard process. But in all seriousness, are there any other questions that anyone has?
I think we're good for now. There'll probably be more when you do your update in January.
Hold on, I just see the Q&A come up here. Are those the same questions we just had?
I believe
Someone
so.
did write something about
Oh,
529.
I see the terminal shop. You buy a sandwich, the computer asks for a tip. If you the person who is making the tip doesn't really care. It's the employer. I don't know what the internal workings there. If it's voluntary, then the servers who work in that institution in the terminal shop, I would seem to me those tips would be qualified. Okay. $529 Roth conversions are not on OBBBA. They already existed. They were from the Secure 2.2.
Frank, people on the chat are saying thank you and an excellent webinar. So
All right, well, good. I hope everyone learned something today. I hope to see many of you on January 7th, 2026. I think Jeff has it from 6 to 9 p.m. I will encourage you to join NYSSEA. I think you get your benefits there. And Jeff, I think you have another webinar coming up. What is it, in
Yes,
2 weeks
I believe on the
from today?
I think on the 17th, I believe.
Yes,
All
on the
right.
17th, we
All right,
have
so
AJ
thank you all
Reynolds.
for participating, and hopefully you all have a good tax season. As I said, I hope to see some of you on January 7th.
Yeah, thank you, Frank. This was really, really great. A lot for us to chew on. And yes, coming up on the 17th, we have AJ Reynolds on Form 4797. So if you have not signed up, please hurry up and do so. It's going to be great. AJ Reynolds is always great. So thank you again, everyone. Have a wonderful evening, and we'll see you all on the 17th. And that's in the evening, 6 o'clock, right? 6:30. Okay. Thank you, Frank, as always. You're the best.
Take care, everyone.
Okay, bye-bye.
Bye.